Good evening, everyone. Hope I'm audible and clear. If at any point you can't hear us, please put in the chat box. Thank you for joining us today. And let me start as usual with a summary of the monetary policy call, as well as our general views on macro and fixed income markets. So, the policy review today was decidedly dovish, in a sense that, market was basically looking for three things: a rate cut, dovish guidance, and prospects of OMOs. This was the best case as far as market expectation was concerned, and those were pretty much delivered. Um, Let me just tell you about what the going in scenario for the policy review was. So, as many of you would know, the last 1.5 weeks have been slightly volatile for the fixed income market. It all started with a stronger than expected real GDP print, which led some market participants to believe that RBI may not be in a position to cut rates in this policy. Secondly, we have had heightened INR volatility. So the rupee dollar breached 90 for some time. In fact, it's closed very close to 90 today. And that again led some people to believe that probably RBI won't be in a position to therefore ease monetary policy. Given that context, like I said, it was a decidedly dovish policy, tick marking almost every box the market could have hoped for. Let's just analyze in slightly greater detail what the dovish elements were. So not only was repo rate cut by 6-0 consensus, one member chose to stay with a view that stance should be changed to accommodative, but five of the others did not agree with that. More importantly, the analysis and expectation with respect to both inflation and growth are quite constructive for the bond market. So on inflation, not only have forecast for this financial year's average brought down by roughly 60 basis points, but Q1 and Q2 for the next financial year have been brought down as well. So the RBI now projects average CPI for the current year at 2%. Q1 for next financial year at 3.9% and Q2 at 4%. So basically for the first 2 quarters of the next financial year, inflation is expected to remain at 4% target. Not just that, the MPC and the governor assess that underlying inflationary pressures are even weaker than what they appear on the surface, because 50 basis point of inflation is being contributed to by valuables, so gold, silver, etc., which is of the nature of rising commodity prices, and what can rise can hopefully not rise as well. And there is very little signal from a demand side inflation here for the Monetary Policy Committee. So it's quite notable that they have stripped out this 50 basis point of upward movement because of gold and silver prices, and therefore they are terming the underlying inflationary forces as even weaker. On growth, H1 has been very strong, as we all know. But that is really a real GDP effect because deflator has been very low. What is of probably some concern, generally speaking, is nominal GDP growth rate has been in the mid eights, which has to be closer to 10.5 for India on a sustained basis. Nevertheless, not only have MPC not gotten swayed by the higher real GDP, they're also projecting that going forward GDP trajectory, although expected to remain strong, has uncertainties. And if you see the projections also, from the 8% mark, it progressively reduces. Quite judiciously, the MPC and the RBI governor are talking about external headwinds to growth. So as we know, there is an effective tariff rate in play for India versus the US currently, which is in excess of 30%. And the longer it stays, unfortunately, the more damage it can do to growth. And there's something the RBI is quite cognizant of. So to summarize, quite dovish on inflation, pointing to the fact that even at 4% next financial year and 2% this year, there is a 50 basis point this year upward pressure because of gold and silver. Not really getting too excited about H1 growth rate and focusing on how there may be some pressures on H2 and going forward. And third, and also equally importantly, currency has no mention in the interest rate setting, which is how it should be, because unlike a previous episode which belonged to 2012-2013, where currency weakness was led by expansion in current account deficit, and therefore monetary policy had a role to arrest that. In this phase, current account deficit remains at around 1 to 1.5%, even accounting for some expansion in trade deficit recently. Inflation remains quite low. And therefore, there is no role absolutely for monetary policy in currency defense. In fact, quite the contrary. Lately, economists more and more seem to be of the view that the RBI has been clever in allowing the currency to depreciate a bit more recently, because it serves to offset a bit of the tariff pressure that we are facing currently. So, as you know, a weaker currency makes our exports more competitive and imports more expensive. And therefore, it is a bit of an auto balancer as far as the external account is concerned. So there's absolutely no concern with respect to a weaker currency and any implication it may have on monetary policy. Also, very importantly, therefore, from a bond market standpoint, the forward guidance does not fully close the door on further rate cuts. We would also say that the incremental utility of additional rate cuts is quite minimal. So whether or not they choose to cut one more time is anyone's guess and pretty much a judgment call. But the important factor from a bond market standpoint is that the expectation channel is not closed. One way to think about it is to contrast this with what happened in the June policy, where even though RBI MPC cut by 50 basis points, the guidance was so hawkish that the market led to a broad-based sell-off because the expectation channel was completely compromised. This is exactly the reverse of that. Rates have been cut, and yet the expectation channel is very much alive. So all told, on the monetary policy front, it was decidedly dovish as far as the takeaways are. Not just that, but what we were quite pleased to see is that the governor has taken pains to also address some of the other misconceptions or myths of the market. So, the way to think about the current policy, I would say, is that one of the big jobs of the central banker is to provide interpretation to market and economic agents, so as to be able to reduce the uncertainty that market and economic agents face. So, if they only focus on action and not commentary, then the market goes away confused. However, what we are seeing since October with this RBI and what got reaffirmed today is that this RBI and MPC is also now focused to minimize volatility in market by interpreting the macro scenario and other variables for the market as well. So we just discussed, the RBI MPC's interpretation on the current growth versus inflation trade-off, which is very much pro rate cut cycle. That currency should not come in the way of monetary easing because that is not linked to interest rates at this juncture. And two other aspects which the governor touched upon, which are also very important. So one, some people would recall that somewhere in November, the RBI had purchased around 25-30,000 crores of government bonds via screen in the secondary market. And that had again led to some speculation that, look, RBI is doing yield management. In fact, at whatever point in time the RBI has come out with open market purchase of bonds, there is at least a section of analysts and market participants that immediately attribute that to RBI doing yield management. In no uncertain words, the governor today clarified that OMO operations are done to address core liquidity and they are not meant to influence the yield curve. So what he said is that, when we change short-term rates or repo rate, they will transmit across the yield curve to some extent, but OMOs are not done to address bond yields. And I think that clarification was very important in order to cut this misconception that OMOs are also done to manage bond yields. Let me explain a bit more here. So there was a phase during COVID where OMOs were indeed done to anchor the 10-year bond yield. But outside of that COVID phase, at least we can't think of any other previous or current OMO episode where volatility in bond yields was the major objective to do OMO operations. And we say that because almost every instance of OMOs, we have been able to pretty much anticipate just basis the calculation of system core liquidity as it stands today and going forward. So even this 1 lakh crore of OMO that has been announced for the month of December, Pretty much ours and a lot of other market participants' expectation was that close to 2 lakh crores of OMOs may be required, in fact, will be required by 31st March of next financial year. For that reason, we do expect that the 100,000 crores of OMOs that have been announced for December may not be the end of it. We think there is probably another 100,000 crores of OMOs that may be required over Jan to March quarter. So that's an important clarification the RBI made. There's one other liquidity tool that RBI announced, which is a 3-year FX buy-sell swap, which will also infuse around 50,000 crores into the system. So between the 1 lakh crores of OMOs over December and 50,000 of FX buy-sell, 1,50,000 of liquidity is getting infused. And like I said, we would expect another 1 lakh crores to happen between Jan to March. The last clarification, which was also reasonably important, which the governor provided is, so, you would recall that the RBI liquidity operations constitute basically two legs. One is their view and addressal of permanent liquidity, which is to say, how liquidity is going to be currently and in the future, and whether they need to infuse or absorb liquidity through more sustainable tools like OMOs, FX swaps, etc. And then there are short-term operations that RBI does through the VRR, VRRR mechanism. Now, sometimes there has been a propensity with market participants that, let's say in an easy monetary policy scenario, suddenly large-scale VRRRs are announced to absorb system liquidity. Then some market participants get a little bit anxious that maybe RBI is not as dovish as we thought it is with respect to liquidity. So the governor rightly clarified that these operations should not be confused with permanent liquidity injection or withdrawal operations. So RBI is injecting permanent liquidity through OMOs and FX swaps. However, it is not inconsistent with that operation to also be doing VRR, VRRRs in order to anchor the overnight rate closer to where the current policy rate is. And that's the only objective of the VRR, VRRR exercise, and not much more should be construed from that. So that summarizes, what happened today at the policy. Dovish guidance, rate cut. Door for further rate cut is very much open, at least in market's mind, although whether it happens or not is still a judgment call. Current low inflation is even higher than what you see, because there is 50 basis coming from precious metals, etc. RBI is still not confident about forward-looking growth, as they should not be because of global uncertainties, and liquidity infusion operations have already started through OMOs and FX swaps. Now let's turn to a summary of both the underlying global and local environment heading into this policy and the way we are looking at it. So one of the big macro points that we have been focused on this year is that the US dollar has depreciated for most of the year, but for the last few months, the US dollar had stopped depreciating, which is to say that it had stopped weakening both against developed market currencies and lately versus developing market currencies as well. India never felt the benefit of USD weakening this year because we haven't had too much capital flows, and INR has seen consistent depreciation pressure. But if you see a lot of other emerging market currencies, they were appreciating for the first few months of this year, but lately they were under a bit more pressure. So, probably some of the worst narrative with respect to the US economy did not come to pass this year. So people expected, because of the tariff and immigration shock, there may be a substantial drawdown in US growth, but that did not happen. Probably for a variety of reasons, including the AI related capex that has held up growth better than what people thought. Financial conditions in the US remain quite loose, and therefore aggregate spending has still been large, even though there is a K shape which is getting accentuated, which is to say that the lesser well-to-do who don't have asset ownership are struggling, whereas people who are in the higher income bracket and owners of asset are actually doing quite well. But on aggregate, consumption is still doing pretty okay in that economy. So, one of the things to therefore consider is that if the US dollar is not weakening anymore, then the degrees of freedom that emerging market central banks have diminishes somewhat. Now, this is a monitorable that will remain for us and for a lot of investors going forward as well. The sense right now we have is that you will not have any sort of a runaway appreciation in the US dollar. So what you're probably witnessing is the worst of depreciation having stalled for now, and we are sideways. Although incrementally there are one or two developments which are leading us to believe that you may have again a phase of depreciation. So, uh, the narrative with respect to the new Fed governor or the new Fed chair and how they may approach monetary policy has picked up again. There is a sense that Japan is about to hike rates, so the Japanese yen depreciation has been arrested for now, and so forth. So, this is one variable that we will be looking at as to how the US dollar behaves from there, although it's not as material, but something to watch for. The other important point with respect to the domestic economy in India is that this year will probably mark the second consecutive year where India's balance of payment is negative. And this has not happened for a very, very long time, which means that growth capital has not been coming for some time into India, leading therefore to rupee dollar pressures and so forth. Now, the sense is, and partly the hope is that most of this is behind us. And again, I say that for two reasons. First is India has seen a nominal GDP growth slowdown, which has slowed the narrative as a growth economy, but that may now be rebounding. So, a lot of unintended monetary policy tightening, regulatory tightening, and a bit of fiscal tightening is all been reversed now. So monetary policy has eased rates again, liquidity has been made available again, and a lot of regulatory policy is being turned. And the worst of fiscal consolidation is behind us. The government is now neutral on fiscal policy. So all of these will probably start to show in nominal GDP growth rate pickup, which should start to re-establish India's narrative as a growth economy. And therefore, capital flows from the rest of the world will hopefully start to get restored. We are getting some glimpses on gross FDI, inward FDI beginning to pick up, and we hope that that continues. The second reason to be somewhat optimistic is that the currency has actually cheapened quite substantially. And everyone recognizes that India is a great medium term growth story. It is the fourth largest economy in the world and so forth. And now you're getting an entry point in terms of currency, which is, let's say, 5% cheaper than what it was a year back. And that by itself may start to excite some bit of FPI flow. In fact, initial narratives on that are already, starting to do the rounds. So, that is something which has been a monitorable so far, but one hopes that some of this starts to correct, and therefore some of the pressures on the external accounts start to get alleviated. The next somewhat related point is because of the slowdown in nominal GDP growth rate and because of tax cuts, government's fiscal flexibility this year has been missing somewhat, which means that the government has seen a slowdown in tax revenues. And therefore, even though they will meet the fiscal deficit target, they don't have too much buffer to go wrong on their calculations. And therefore, what one also looks forward to is some pickup in nominal GDP growth rate, rebuffering government's tax revenues, some bit of pickup in asset sales that starts to get government capital revenues or capital receipts rather going again. And one hopes that a bit of fiscal flexibility gets returned to the government starting the next financial year. What one also has to remember is starting the next financial year, we move to the debt to GDP framework for the central government from annual fiscal deficit targeting. So there is a chance that the government seeks a bit more fiscal flexibility while committing or continuing to commit to medium-term debt to GDP reduction. So the only conclusion from that is it's again a monitorable that one has to watch for. One is not really attributing any major fear of fiscal slippage, but at this juncture, the only thing one is really thinking about and watching is some bit of fiscal flexibility needs to be restored with the government, which one hopes will happen in the near future. The third aspect which I wanted to touch upon, which is a continued problem right now for the bond market, is a reasonable lack of risk appetite in the system. So what we have seen this year is that most investors into the bond market just don't have the depth of demand that used to be the case earlier. Now, you could attribute this to a rebound in credit demand, but in fact, in the first half of the year also, demand for government bonds was relatively weak. You could attribute this to change in accounting norms with banks, which disincentivizes running large mark-to-market books. You could think about slowdown in pension insurance sector that has to some extent curtailed the demand for long-end bonds. But whatever the mix you think about, the fact of the matter is that risk appetite in the bond market is not what it used to be. And therefore, when you think about the bullish factors, you have to think about some of these factors as well. So, before I proceed, let me say right away that this is not an unequivocal bullish market in a sense that you buy anything and it will make money, in our view. At the same time, there is enough to play for, especially after this last RBI policy. And which is why it's very important to basically discuss all these nuances and factors that are impacting the bond market and therefore what the net strategy for bonds should be like. So far we have discussed a dovish RBI policy, probably prospects of further rate cuts or rate cut, one rate cut, which may or may not happen. OMOs that have restarted, RBI's focus on liquidity back. However, on an international front, the dollar index not having fallen so much lately, but there is probably some hope that it resumes its fall. Most of INR depreciation probably behind us, and some hopes that capital flows restart after a 2-year hiatus. Government fiscal flexibility is slightly compromised in the near term, but again, one hopes from next financial year as nominal GDP growth picks up, it gets restored. And finally, risk appetite in the bond market being relatively weak. One additional factor I should talk about is the supply of duration to the bond market. Now, again, this is not just to do with the central government bond supply. So, there was a phase where the market's sense was that the government of India is supplying too much long in duration, but that is not the case anymore. They have readjusted the supply calendar, etc. What seems to be also an issue is the duration of SDL supply, which has also gone up. So if you combine a relatively muted risk appetite in the bond market alongside heavier duration supply, you basically get steeper yield curves, which is what we are getting. And our sense is you have to basically make peace with that thing. And therefore, it's very important to decide what segments of the bond market you want to really play and what segments you want to avoid. So, like we discussed, there is still enough to play for. And don't underestimate at this juncture the length of time the RBI may keep monetary policy proactive. Because, if the international uncertainties were to not de-escalate, then RBI will have no choice but to keep repo rates quite low at current or 25 base point lower. And the length of time that the overnight rate remains here also has a bearing on your investments. So it's not just, the next rate cut, but also how long the current level of overnight rate gets held. Secondly, even though the bottom on inflation may have been touched, there is no real reason to believe that inflation will sustainably move up. And one of the big reasons why is this excess capacity that China is sitting on and which just refuses to go away. So China has no option but to continue to export out that excess capacity. And therefore, manufacturing-led inflation, as we used to see in previous cycles, is probably not going to happen for the foreseeable future. Neither is it likely that a demand-driven inflation in commodities were to happen. Again, courtesy the excess Chinese capacity. So you could have supply disruptions, leading to spike in commodity prices or hard commodity prices, but unlikely that there are demand disruptions or demand-led inflation that will happen in those. And the RBI seems to be also pretty much of that view. So to clarify, there is enough to play for in the bond market. You probably have entered a long period of low overnight rates. At the same time, there is enough duration supply and risk appetite is muted. Now, in that context, let's analyze the two yield curves, which is the government bond curve and then the corporate bond curve. Now, just to put some loose levels on the table, they could be 5 or 10 basis point here or there. On the government bond curve, the 1-year treasury bill is roughly at, so first of all, the overnight rate is at 5 quarter. The 1 year treasury bill is roughly at around 5.5. The 5 year government bond is roughly at 6.2 to 6.25. The 10 year government bond is roughly at around 655. And the 30 year government bond is roughly at 725. So to just analyze the term spreads here, the 5 minus 1 spread is roughly around 90 basis points. The 10 minus 5 spread is only 30 basis points. And then the 30 minus 10 spread is around 80 basis point. Now, one way to think about it is to say that the 30 year is very cheap and because it's so steep to the overnight rate. But if you were to break up this steepness into pieces like I just did, you will realize that the curve is steep actually at various places. So even the 5 minus 1 at close to 90 basis points is very, very steep in an environment when the RBI is so dovish. And this steepness of the curve is nothing but the exhibition of lack of risk appetite in the marketplace. Now, once you have made peace with the fact that market risk appetite is likely to continue to be weak, you have to be careful to position yourself on those points of steepness where you will probably be able to unlock gains through well-decided drivers of demand. So for us at this juncture, going long on a 30 year, and this is just the thinking as of date, does not have the potential triggers which makes us confident that that would make money because there is this SDL supply to contend with, there is this, duration supply to contend with. And if you measure steepness at various other points of the curve, although the 30 year looks steep, but there is steepness at other points on the curve as well. However, if you analyze the 5 to 8 year point on the government bond curve, you find that it's very steep to the overnight rate, very steep to the 1 year rate. And this is something you could play for because as market surrenders more and more stock to RBI under OMOs, and as the overnight rate remains in the 525 quarter vicinity, there is natural balance sheet and investor buying that accrues in the 5 to 8 year sector. And therefore, as far as the SLR curve is concerned, that is the sweet spot to us. And a lot of our fund positioning is playing market beta or market participation via the 5 to 8 year of the sovereign curve. Now look at the non-SLR or corporate bond curve. And the dynamics there are slightly different. So unlike the SLR curve, the non-SLR or corporate curve is facing pressure from the 1 year point because credit to deposit ratio is now rising. So we think, what may happen on the corporate curve is the 1 year point may not be able to fall too much because there'll be perpetual demand to raise more deposits to fund credit growth. And therefore 1 to 3, 1 to 5 year is basically the spot that you really want to play there. Not much beyond that. The other thing that may happen over the next 2 to 3 months is SDL supply will go up because so far SDL supply has been more limited. But let's say over Q4 as an example, we expect more than 4 lakh crores of SDL issuances and December is also not yet done. Corporate bond supply may pick up. And on the government bond curve, you will have the benefit of OMOs. So the demand supply equation between the government bond curve and the corporate bond and SDL curves may be favoring the government bond curve. And therefore also it becomes important to play the so-called market beta via the government bond curve and not so much through the corporate bond or the SDL curve at this juncture. Maybe the equation changes by Feb or March. So if you analyze therefore the macro environment, the underlying context and triggers for the bond market, what you basically arrive at in our strong view is as follows. You want to participate in market largely via the government bond 5 to 8 year. You want to use most of the corporate curve largely in the front end up to 4 or 5 years for carry purposes. And, because corporate spreads are 50-55 basis points, so people don't want to lose that. But that is largely the extent of positioning that you want to do in the market. We are not exactly at the end of the cycle. Like I keep saying, there is enough to play for and one has to keep an open mind right now as to how much growth impact, etc. can happen. At the same time, you are not even at the early or mid part of a cycle that you could go all out on duration or anything like that. So as investors, we have to be careful on the maximum maturity exposure that we want to take in the market. At the same time, probably not get overly defensive and go 100% into carry, because those kinds of overly defensive positions are typically taken at close to absolute end of the cycle. And the last point before I conclude and open for questions, and a point I made before, but I want to reiterate again. See, it's not just about whether there is one more rate cut or not, but the ability of RBI to hold on to 5-quarter overnight rate for an extended period of time. And nothing in the macro or RBI commentary at this juncture suggests to us that anywhere before 2027, let's say, or anywhere in the immediate forecast horizon, there is any risk of a rate hike. So therefore, even when rates have bottomed out, you could probably look forward to an extended period of 5-quarter. Obviously, if anything major changes in the world, one has to revise that view. But at this juncture, for the reasons that I mentioned, that's how it's looking. So portfolio strategies, investment strategies also have to take into account this fact that, as an example, liquid fund allocators will soon face reasonably suboptimal returns because 3-month money market rates will start getting pulled closer and closer to the overnight rate. Obviously, the busy season dynamics and Jan to March dynamics will be therefore in play. So you will be called upon to probably take the next step on what you can do while keeping total risk in check. And therefore, some of these dynamics, it's important to keep track of.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.